In part four, we'll talk more about company stakeholders and how they interact with each other and how they contribute to the success or failure of the company. The network of company stakeholders starts with the customer, because without the customer, no one else can make any money. And we have here the suppliers, debt investors, equity investors, the board of directors, the auditor, and the government that round out the list of stakeholders. To review a bit from where we started, the goal of every company is to maximize profits for equity investors, their owners. So to do this, companies compete against each other and also partner with each other to maximize sales from customers. We're familiar with how companies like Nike and Under Armour compete with each other. Starbucks competes with an array of cafes. Amazon competes with brick and mortar retail companies like Macy's and Kohl's. There's many examples of competition in various industries to win our business. Companies can also partner with each other. For example, the partnership between Microsoft and OpenAI, where Microsoft invested in OpenAI and also used their technology in some of their search products. The CEOs are the ones who are responsible for managing and balancing the competing interests of all company stakeholders while rewarding owners. In order to reward owners, they also have to keep the other stakeholders happy, because they have the choice to walk away if they want, especially customers, but also suppliers and lenders and employees. And companies are attracted to sales opportunities where they see high profits. Wherever there's high profits, companies are going to be tempted to enter those markets and industries. So companies that are successful cannot really rest too comfortably, because they know that if they look over their shoulder, there's going to be competitors, even from outside their industry, who are going to try to muscle in and take some of the sales and profits for themselves. So it's a very competitive environment, while at the same time, there's also an element of cooperation, because, for example, with partnerships, companies do need to work together, and companies also have to cooperate with their customers. Customers are the kings and queens of the economy, at least in the US economy. The customers drive the growth and the nature of the economy. What we buy, what we choose not to buy, determines how the economy looks like, and whether we are in a recession or in a growth phase, and whether there's inflation or not. It's basically our decisions that drive most of what we see in the economy. Customers choose which products they want to buy. In most cases, we have the freedom to choose. Where we don't have the freedom to choose, someone else will either influence us or make the decision for us. For example, a government can dictate to us which specific products we need to buy, and even which specific companies we need to buy them from. But as long as we have the choice, customers decide which companies fail and which ones succeed. For example, customers stopped buying products from Nokia and BlackBerry and decided that Apple should be the winner in the mobile phone market. And it was a new market that Apple entered after many years of not being present, and the customers basically fled from the established dominant companies like Nokia and BlackBerry and went to Apple instead. Customers also compete with each other. Customers compete with companies for the best deal, however. We want the most product possible at the lowest price. And in this sense, we're competing with companies for how much we get in return for the money that we hand over. Customers compete and also cooperate with each other. So if you think about yourself, you might post customer reviews, and this is helping other customers to evaluate products that they have yet to buy. There's also customer cooperatives. For example, there's a supermarket in Brooklyn that I go by sometimes, and it's a cooperative where different shoppers get together, pay a monthly fee, and then they have access to relationships with suppliers who sell them groceries. And then within this community of customers, they benefit from that setup. But as we all know, for example, during holiday shopping, customers will also compete with each other. We're trying to get the best deal before someone else can find it. Suppliers are companies that sell to other companies. Suppliers and their customers also compete for the best deal. So once Amazon has sold a product to a customer, the suppliers of Amazon are trying to assess and trying to compete for the largest share of the sale that Amazon has made in order to sell their products more attractively. So suppliers try to get the higher price, just like Amazon tries to get the higher price when they sell to their customers. And foreign suppliers and their domestic customers are affected by tariffs. So as you may have been hearing with some of these tariffs and the news that they generate, a lot of suppliers are located overseas. For example, if you're a car manufacturer in America, even if you manufacture the car in America, your suppliers can be in other countries. And the relationship between the government and the foreign suppliers also can affect the way that your suppliers interact with your company. Suppliers can also become direct competitors of their customers. So you have to be careful if you're Amazon or any other company that the suppliers who are helping you succeed may one day decide to compete directly with you. There's a famous family-owned Italian fashion company called Zegna. They used to supply fabrics, and then a couple generations later, they decided to compete directly with their customers who were clothes makers, and they started making clothes themselves, for which they are still famous today. Customers can also become direct competitors of their suppliers. So just like the suppliers of a company can decide to compete with the company can decide to compete with the supplier. So an example of this is Google and Apple used to buy all their chips from semiconductor companies, and they've decided to make their own chips, either because they feel they can do it more cheaply or they can get the features that they want, or maybe they decide that they can develop the chips more quickly than their suppliers can. GM makes its own batteries. Previously, car makers did not make batteries, nor did they make electric vehicles, but with electric vehicles becoming popular, GM has decided to not only make its own batteries, but also to mine its own lithium. So if you're a lithium mining company, you have to think about what sort of value you can add to battery makers and to car makers to make sure that you can compete by selling lithium to GM and also buying and owning and operating the most attractive lithium mines without letting them fall into GM's hands. And then a recent news item is that Coinbase created its stable coins, and it's potentially going to benefit from some new legislation. These stable coins, the reason why the Coinbase stock price went up so much is because investors think that Coinbase can help displace traditional payments providers, including companies like Visa and MasterCard, which are extremely powerful and extremely profitable payments companies today. They also work very closely with credit card companies, as you know. And so by expanding beyond its core competency of being a crypto exchange and delving into the payments sector, Coinbase is, in fact, working against some of the companies that may have helped it to succeed up to that point. Employees, just like suppliers and customers, they try to get the best deal possible. For every dollar of sales to a customer, employees want to get the maximum share of that. It's understandable. So they try to maximize their wages, their vacation days, remote work plans, health insurance, 401k, etc. All these demands and all these expectations of employees have to be considered by companies who want to get the best talent possible, but also at the best wages possible. That is to say, the lowest wages possible. So there's this inherent competition between employees and their corporate employers. Employees can, of course, create unions to collectively bargain for benefits, and this gives employees potentially better bargaining power when they negotiate their compensation packages. So employees can choose their employer, but once they're employed, they have fewer freedoms than they do as citizens. So this is an interesting point that although we live in a democracy, politically speaking, we have these freedoms and rights. Once we start working for a company, we have to follow the dictates of the company, and we have to meet the expectations of the employer, especially the manager who's looking after us. And if the manager isn't someone you get along with, obviously this is very, very difficult. Employees have specialized roles within the company, and they're getting more and more specialized as technology becomes more prevalent. And this is very similar to other institutions like the military or sports teams that have specialized roles and also use hierarchical organization to manage the interactions and the output of the employees relative to what the management hopes to achieve. We've discussed two different types of investors, which provide two different types of funding to companies. There's basically two types of funding, and you'll hear this over and over again, so don't worry too much if it sounds confusing because it's the first time you're hearing about it. The two types of funding are equity and debt. Equity is ownership of a company. Debt is lending to a company. For now, that's all you need to know, but keep those two basic facts in mind. Equity means ownership, debt means a loan. So equity investors and debt investors compete not only amongst themselves, but with each other to get the best deal from a company. For example, if a startup company is selling shares to new investors because it wants to fund its operations and product development and its infrastructure build out, it's going to look for the wealthiest and most enthusiastic equity investors possible. On the other hand, equity investors are looking for the hidden gems among the startups, for example, possibly, or even among bigger companies, which have great potential but may not be well recognized or even identified by other investors. So there's this constant back and forth about what is the value of owning a company. And the equity investors want to pay the lowest price. The company and the existing owners want to sell equity for the highest price. Debt investors want to receive the highest interest rate possible from a company, and the company wants to pay the lowest interest rate possible. And you, as an investor, you have a choice. You can decide for every dollar of savings you have, do I want to invest it like an owner or do I want to invest it like a lender? And depending on the interest rate that you can get versus the price of the equity that you have to pay, you might decide that one or the other is better based on your assessment of the risks and also where you are in your stage of life. For example, once you've retired and you're living off your assets, you may decide that you don't want to take such a big chance on startups, and you're much more satisfied earning a lower rate of return from owning debt. So investors compete against companies, but we also have to support them too. When companies run into trouble, the equity and debt investors have an incentive to communicate with each other and try to negotiate a best outcome, because if the company goes bankrupt, no one does well. On the other hand, if the company succeeds, then both the owners and the lenders of the company will do well. So it's a combination of competition and cooperation, just like with the other stakeholders of the company. So the board of directors is an interesting stakeholder. You can think of them as being the middle person between companies and their owners. We as owners outsource oversight of CEO and company performance to the board, and we rely on the board to keep the CEO working hard and making sure that they're making good decisions, getting sign off on strategy, and maximizing our profits in a way that's consistent with the regulations and values of the company. Now, we as owners elect board directors. Board directors are not employees of the company, but the board of directors has the power to appoint the CEO. If company profits don't meet expectations, owners can remove directors from the board and fire the CEO. Occasionally, boards will side with the CEO against the owners. And then at the annual shareholder meetings, it's up to the owners to introduce resolutions and to get majority support behind these resolutions to vote board directors out of office and to replace them with board directors who are more aligned with the opinions of the owners, and either replace or convince the CEO to make changes. an example of where there was this sort of conflict. Tesla was originally incorporated in Delaware. We're talking about the electric vehicle company. And in 2024, Tesla board approved a $55.8 billion pay package for Elon Musk. One of the Tesla shareholders sued the Tesla board in Delaware, the state of incorporation for Tesla, and won. And the judge, Kathleen McCormick, said as part of her reasoning, the process leading to the approval of Musk's compensation plan was deeply flawed. So here we have an example of the interaction between the board, the stock investors, the CEO, and the government represented by the judge. And it's this dynamism between the competing interests of these various stakeholders that's in play constantly every day throughout the economy and thousands of companies. To go a little bit more into the debt investors, let's go through a little bit of jargon first. Debt investors are also called lenders or creditors. It's the same thing. So when we talk about lenders or creditors or bond investors, think overall that they're debt investors because they're investing in the debt of the company. And typically there's two ways to invest in the debt of a company. They can either lend a loan to the company, and typically banks do this, or they can buy the bonds of a company. Larger companies will sell bonds rather than take out loans from banks, because by selling bonds, they can attract much more money from millions of bond investors rather than from a handful of banks. So the volume of money that they can borrow is potentially larger within the bond market as opposed to the offerings of a bank or a syndication of multiple banks. And instead of receiving profit, debt investors receive a rate of interest that's agreed upfront and it's known ahead of time. The interest rate can be fixed at a particular number, like 4%, 5%, or it can be a floating rate. The floating rate means that it adjusts based on some other interest rate, which can change throughout time. This may sound a little weird, again, because if it's the first time you're hearing it, but as an analogy, you can think about your credit card. If you carry a balance, you'll see that the interest rate on the balance can fluctuate up or down. And in that case, that's also a floating rate of interest. On the other hand, if you bought a home and you have a fixed rate mortgage, that means no matter what interest rates are doing in the rest of the economy, you're going to pay that fixed 7.7 or 7.5%, whatever mortgage rates may be. And of course, it depends on the amount of the loan, the length of the loan, the duration of the loan, I should say, and your credit score. So debt investors usually do not benefit from higher profits. Creditors or debt investors can only claim interest payments that are determined by the interest rate of the debt. We already gave the credit card example. So creditors usually prefer steady as she goes versus a let's shoot for the moon type of mindset because they don't get any of the upside. On the other hand, if the company goes bust and it goes bankrupt, then the creditors have the potential to lose everything that they've loaned to the company. Creditors, however, can protect their debt through covenants, which means that they can restrict companies from doing certain things like borrowing too much. They can also protect their debt by asking the company to put up collateral in the form of assets, which revert to the ownership of the lender if the company goes bankrupt, much like a home reverts to a bank if the homeowner cannot meet their mortgage payments. And creditors also have a lot of support from the government in terms of their legal protections, especially in a bankruptcy scenario. And to summarize, the debt and equity investors, the interest rate paid on debt is a thank you from the company to the debt investor. Thank you for your trust. Thank you for the money that you've lent to me that I can use now to invest for future products and future profits. And the dividends paid on equity is a thank you from the company to the equity investor. Thank you for buying shares of this company and providing us the funds to invest also in future products and future profits. So there are basically three sources of capital for a company. And the company can get money, investment money, either from selling shares to new investors, retaining earnings from their current business, rather than paying them out as dividends, they can keep them and invest it and tell the shareholders, just give me a couple of years. Let's see how the investments go, and then I'll create better products, more products, or cheaper products that will lead to higher profits. And the third source of capital is loans. So remember these three things: sales of shares, retained earnings, and loans are all sources of money that we provide as investors to companies. And it's our choice, based on our personal preferences for risk and expectations for future income, as to whether we want to provide capital to companies either through loans or through equity. Auditors are an overlooked but very important stakeholder. They basically double check the financial records of the company. The reason why this is important is because many investors use financial records of the company to evaluate the growth in income, the growth in sales, and various aspects of its balance sheet. How much debt does it hold relative to how much equity it holds? And by analyzing these records over time, investors have a sense of how their investment is doing. If the financial records are questioned for their integrity or accuracy, this tends to create, as you can imagine, great nervousness and uncertainty among the investors, both the equity and the debt investors. So over the course of not only decades, but centuries, auditing has become an incredibly important function to say, not only is the company doing its best to generate accurate and timely financial records, but they've also contracted with an outside professional accounting firm to double check their records. And importantly, the CEO does not appoint the auditor, it's the board of directors. So the board of directors, as one of their responsibilities to oversee the performance of the CEO, appoints the auditor and tells the auditor to do the checks and then report back to them on how the CEO and the chief financial officer are doing in terms of recording the results of the company's operations and also their forecast for future profits and costs. The auditors and CEO and the board are legally liable for the accuracy of their financial records, which adds an additional incentive to take it very seriously. And auditors, along with the board, provide another check on the performance of the CEO. So if you think about companies that misstate their financial records, and it tends to be rare, but it does happen, and some of the companies that do not manage their financial records well or outright lie, they can implode quite spectacularly. Enron was an example of that in the early 2000s. At one point, they were one of the largest companies in America. But in order for something like Enron to happen, not only does the CEO and the CFO of the company have to fail, but the board has to fail, and the auditor has to fail, and the investors, who are the ultimate check and guarantor of the performance of the company, they also have to take their eye off the ball. So there have to be multiple failures of checks and balances in order for something like that to happen. Now, the government, the agencies and legislatures that comprise the government are also a stakeholder of the company. The government will regulate, in some cases compete against the company, and in other cases tax companies that they want to punish, let's say, or they'll subsidize companies that they want to favor. So governments are also customers of companies. The Pentagon is a huge customer of defense companies, for example. And governments intervene between stakeholders to pick winners and losers. So you can think of government intervention as being a scenario where it looks at the relationships that a company has with its stakeholders, and it decides that one of the relationships or more is something that they don't like. So an example will be antitrust case against the big tech companies, Amazon, Facebook, Google, and Apple. In this case, the government decided that these companies were competing unfairly and that they were illegally preventing competitors from selling to their customers. An example of this is the App Store for Apple. Apple was not allowing gaming companies to sell different services to their customers outside of the App Store. So all of the revenue incurred from selling services to customers after the game had been purchased had to go through Apple, and Apple was taking a huge percent of those sales. And the gaming companies were like, look, we've already sold the product through the App Store. You've taken your cut. Now we have a relationship with the customer. You shouldn't force us to use the App Store to sell them further services like gaining extra points or extra accessories for the games that they were playing. And there's other examples of this where the government will step in and say, for example, in the oil refining industry, they'll say to the refiners, you have to buy a certain quantity of ethanol to mix in with the crude oil that you're refining. It's not something that the oil refiners would do on their own, but they use the moral argument that the ethanol helps to reduce carbon emissions, and also the economic argument that it's good for the Midwest farmers who have a big and steady market for their corn and I think it's soybean products that are used to create the ethanol. So the government intervened and told the oil refiners, you have to buy this. And then they created all these different rules for how much to buy, how much to pay, when there's exceptions, etc. A lot of valuable assets in the economy, like airports and bridges and utilities, are actually monopolies, meaning that they don't have any competition. Companies are not allowed to have competing airports that are too close to each other. And if they are close to each other, they have to be owned by the government. Most of the airports and bridges and a lot of the power utilities in the US are actually owned by the government. They said, these assets are so valuable and so unique that we want to own them. We don't want private companies to own them. And whether or not you like it often depends on whether you think the government is the proper owner and operator of these things, or whether they should leave that to the private companies and just focus on taxing and regulating them. Tariffs on imports is another great example where the government says to a lot of businesses in America, we don't want you buying or interacting with suppliers from overseas. We want you to source your inputs from domestic companies. And so the tariffs serve as a strong disincentive to buy goods and services from foreign companies. We've already talked about the ethanol requirement, and the tax code is probably one of the biggest ways that the government enforces its preferences on companies. The tax on profits is extremely complicated to administer, and so companies have created lobbyists to talk to governments about the different favors or loopholes that can be granted. And so the tax code, in a way, is meant to raise revenue for the government, but in a way, it's also meant for the government to dispense favors based on which businesses they want to see succeed and which ones they want to hold back and want to discourage. And a good way to think about this, because the government is quite a powerful force in the economy, is the government is like the NBA. The NBA sets and enforces rules on teams and players, and the government sets and enforces rules on companies, but it also favors some companies and competes against others. So you can think of this as the NBA favoring maybe the Western Conference some years or the Eastern Conference in other years, or favoring teams with certain types of owners. And it changes as the government changes based on the election cycle. And the government can also choose to compete. It can field a team in the NBA and then favor its team with special rules and favors. And in those cases, obviously, it's very hard for private businesses to compete with government businesses, government-owned and operated businesses, because governments are not as concerned about profits or customer service as private companies are, because they have the rule of law behind them. And as discussed, many government businesses are monopolies and face little or no competition. Amtrak, passenger rail service, the only one in the country. The post office doesn't allow FedEx or UPS to deliver packages to deliver letters into your mailbox. That's why they focus on packages. If they did have the right to deliver letters, they would probably do that. But right now, that's a monopoly for the post office. So this is the list of all the company stakeholders. We've gone through a lot, and let's go back. The main thing to note about this is that we're going to continually come back to this, and we're going to ask ourselves from the perspective of how does a company go from being, say, a small startup to becoming a globally dominant powerhouse, like, say, Apple started with two founders in a garage, and then 40 or 50 years later becomes a multi-trillion-dollar company. And part of the answer is how well the company can manage its relationship with these stakeholders, because there's a very strong competitive element in the relationship that a company has with all stakeholders. You can think of this again as a sports team. The players of a team want to win, and they want to win the championship, but they also want to get the most playing time and the best salaries. So they're competing with each other at the same time that they have to cooperate with each other, especially when it comes time to compete with other companies and other teams, rather, in a game-like situation. So stakeholders of a company compete against each other to get the most value out of it, but most stakeholders have a strong interest in seeing their company succeed and closely monitor its financial health. So here we have another dimension about how the relationship between the stakeholders leads to the success of the company or to the failure. But the fact is that unless the company succeeds, most of the stakeholders cannot succeed. If companies don't do well throughout an economy, then the government can't raise taxes, customers don't get the products that they want, suppliers don't have customers to whom they can sell, debt and equity investors don't have the ability to buy and accumulate assets in the form of debt and equity that'll help them to generate income to fund their retirement. So all these things are interconnected. So for a company to fail, it means that the stakeholders have all missed the signs of weakness of the company and did not realize that the company was vulnerable to being to failing. And this happens a lot over time, where once dominant companies, you can think of, for example, Boeing and Intel, they were super dominant companies, very profitable, very well respected for decades. And now both of them are suffering terribly with quality problems. They're getting trampled by their competitors. In the case of Boeing, they have tremendous legal problems because of problems with their aircraft crashing. So for a company to fail, all these stakeholders kind of had to take their eye off the ball, and their checks and balances against each other may have gotten out of control, which the CEO of the company was not able to manage correctly or properly. So facts about successful companies. Stakeholders of successful companies check and balance each other out. It's not really a case of whether the employees are able to get the biggest pay possible or whether the customers have really great discounts throughout the year. It's easy for one of the stakeholders to succeed at the cost of another stakeholder, but this is not sustainable longer term. For a company to be successful over years and decades, every stakeholder has to have its expectations met. And it's as much psychological as it is financial. And if you do see a single stakeholder that comes to dominate the others, it's usually a sign that the company's in trouble. It can succeed for a while if that stakeholder is powerful. For example, if it's a set of investors who are willing to support the company, or if it's a government that's willing to subsidize the company. But in the longer run, it's going to make the company weak. So successful companies balance the needs and max out the contributions of their stakeholders and keep them happy, especially customers, people like you and me. And stakeholders succeed when the company succeeds. And if any of this breaks down, beware of investing in the company. It's a warning sign. So we're going to talk further about how the stakeholders of a company contribute to its success by looking at some specific examples. So as we talk more about what company is good to invest in or not, let's just reiterate the warning. which is the most important rule in investing. Good investment results are not guaranteed. If you remember the spreadsheet that we went through, how incredibly the stock market did in the last 40 years, that may not happen even if the stakeholder network performs properly, because there's other factors at stake. There's other risks that can happen, and some of it may be happening right now. Some people believe that tariffs are a risk to the future success of not just businesses, but also to the economy in general. Some people think AI has the ability to wreck things or to really enhance profits. There's strong opinions that lean in both directions. So there's risks. So up next, we're going to talk more about the role of the CEO, whose responsibility is to balance all these competing stakeholders, and through the process of balancing their interests, to somehow make sure that the owners of the company, people like you and me who invest in the stock of the company through our brokerage accounts on the stock market, how we are able to profit from the contributions and the interactions, even the competitive interactions between the stakeholders. So that'll be coming up next. Thanks, and see you on the next one.